Hey everyone, it's Amy Nakos.
And Candice Day.
Hey, we're with the Amy Nakos group. Today, we are going to present to you an entirely new class that we put together. It actually comes with CE credits.
Yeah.
But if you join us in person. So if you're just watching this video, you don't get CE credits, but you can see what we actually are going to be presenting. Our first presentation is coming up next week. So not only is this practice, but you might find it useful. So because this is our first time, you're going to be with us through the potential hiccups of technology. I'm going to share my screen and we are going to get started. So give me one moment.
Look at that.
Look at that.
First technology.
All right, you should be able to see this. We'll find out when we watch the recording. Okay, we're doing a class, Mountain Trends, Market Literacy, Risk Management in Colorado Resort Communities. The purpose of this class is to help brokers and customers understand the difference in mountain markets versus primary markets like Denver. So we're going to be doing some comparisons between Summit County and Denver, and we're going to walk you through special considerations that happen when we do look at mountain properties. I'm Amy Nakos. I've been a real estate broker for a very long time, 24 years, and work in Summit County exclusively.
And I'm Candice Day. I am a part of the Amy Nakos group.
And she's awesome. She's an engineer. I'm an attorney. It makes us slightly annoying.
Bring a unique perspective.
We bring unique perspectives.
And a lot of details.
Details and spreadsheets. All right, moving on. Oh, look at that.
I know. Pretty fancy.
You can learn more about us right there. Here's a quick summary. I'm going to run through the summary here. We're going to talk to you again about how Summit County differs from Front Range markets. We're going to show you how we read core metrics and how we crunch the numbers on that. STR regulations. This is a topic that is, we're going to try to summarize it the best we can, but our short handy guide is 15 pages. We'll walk you through the different considerations of STR properties. Unique mountain due diligence. What are things about mountain markets that are different from the Denver market, for instance? And we're going to talk through an investor lens for people who are looking to buy properties and get rental income on them. So the other thing you need to know is I'm working the slideshow. So that's a little. All right, average price. Candice, am I doing this or are you? Candice, do that.
I'll go ahead and do this. So we looked at the trends all the way back to the 90s in Summit County, where we have data. So you can see some of the downturns of the economy, the cycle that we've been through, and then our most recent cycle in COVID and then since COVID. So one thing we want to share is that overall, since 1993, we've had about 7.5% appreciation annually. So that's pretty good appreciation. Denver has been at 6.25, so we're slightly above the Denver appreciation annually. When we look at just post-COVID, so when we look at 2022 to 2025, we saw an increase of around 12%. Condos went up about 8%, and Denver, and if you want to go to the next slide, we can show Denver, has been about 4%. So very similar trajectories. I think what we're seeing is that the mountain market has been a little bit slower to react to some of these changes and then has also bounced back in different ways.
Great. Volume trends. The thing that we always like to talk about with volume trends is just how much smaller our market is than the Denver market is. So for instance, in Summit County, we have total 35,000 properties. That's it. That's the available inventory, period. That's all we have. So Denver has, I don't know, millions? We don't know. A lot.
A lot more.
A lot. So when we're looking here at the sales count, you can see that our annual sales count recently has been, like let's call it 1,200 to maybe 13, maybe up to 1,400 a year. That's just over 100 a month. So that's how many sales, that's only how many properties we have selling. So we are not a market where we're churning thousands of properties a month. It's about 100 a month. Back at the height, when people were, back in 2003, 2004, we had a lot of new developments and we had more activity back then. maybe about double the volume. Then you'll see in COVID, we were at about the 2,000 number. So that's the trends there. We have about 520 active properties on the market today. Denver has about 9,000. So that will help put into perspective. Was there any other notes?
One other thing to mention is the purple line on here is all properties. So it includes single family homes, and the green line is condos. And you can see they've kind of followed similar trajectories over the years. And we're starting to see, especially in the last year, things diverge a little bit. So we're seeing the condo market slow down while the single family home market kind of keep things propped up.
This chart. A lot of arrows. Go ahead, Candice, you can take this chart.
Yeah, so we use this chart to kind of break down our submarkets, and we're going to dive into each one a little bit. So we'll just kind of stay high level here. But we look at price, the number of sold properties in the months of inventory. We have some big markets and some smaller markets that are more sensitive to price changes. And then we look at the overall Summit County total, where our average price from 24 to 25 was about stable. And we saw a little bit more inventory sold and a little bit more inventory available.
Very good. I think the other thing to note too is when we work with clients and we need to dig into these specific markets, we use these trends, we use these packets to help narrow in on things. What we have coming up here is every single submarket that we service and how we break them down. I think for this, we're going to move pretty quickly through these. Just know that they are available, and we'll talk just slightly about each community so you have a better sense of what these communities are like. Breckenridge is our largest community in terms of MLS coverage. Doesn't necessarily mean it's in Breckenridge, but this goes from the high school at Farmers Corner all the way up to Hoosier Pass. And in Blue River, south of Blue River. So you're going to find most of the properties here. Here you're going to see that annually we're selling about 500. And as I told you, our entire sale for an entire year is like 1,200. So this is a large chunk of the properties that we sell. Average price in Breckenridge is the most expensive market, and single family homes, as you can see in the first chart, are really propping this up. We'll continue to talk about this through this class, but single family homes are the most desirable property type and those that are continuing to move. Anything to add here?
No.
Copper. Copper's our smallest market.
Yeah.
One sale can change everything in copper, and the numbers are more volatile because of that. But when you look at copper, you'll see we sell maybe 40 a year. 40 a year. If you're a copper buyer and you see something that comes up that you like, you should probably act very quickly. Most properties in Copper Mountain are condos.
Yeah.
Dillon, Candice.
Yeah. So Dillon's one of our more affordable areas. There's different pockets of Dillon, some that have single family or townhomes, some that are mostly condos. But we have seen the price actually dip a little bit in Dillon in this last year, partially just because it's that more affordable price range. So we don't have those luxury properties pulling it up. Frisco's probably our hottest market, also a small market comparative to Breck, Dillon, and Silverthorne, but it is expensive. You do pay a premium to be in Frisco. You pay a premium to be in Breckenridge. Frisco has seen a lot of tear downs with new construction. So you'll see on denser lots, townhomes that are coming in, those sell at about 1,200 square foot. So that's why the average price is being pulled up with the new construction. Number of properties sold, our Frisco properties sell pretty quick. So it's really a matter of the inventory, and that inventory tends to be absorbed. Keystone. I'll talk Keystone. I do a lot of work in Keystone. Keystone average price has gone up. We've seen more new construction there also. Kindred is starting to close this month. Or next month. It's going to be May 2026. So be prepared for a giant spike in the average price. Number of properties sold in Keystone, we really kind of dipped in 2023 and are bouncing back a bit. Most of the properties in Keystone are going to be condos. So you'll see that the condos and the single family do trend pretty much the same, because it's pretty much the same line. Silverthorne. Yeah, I'll do Silverthorne.
Okay.
So Silverthorne has seen a lot of new construction along the Highway 9 area in the past few years. So you've seen that number of properties sold kind of tick up. And then it's kind of coming back down. Silverthorne is a unique area in that there's a couple different areas that make up Silverthorne. And a lot of people think of Wilderness, like above Lowe's, as part of Silverthorne. That is technically unincorporated Summit County and has been hit by the short-term rental regulations. So that turnover has been just a different vibe. So the condo market has really steadied. There is new construction and single-family homes within Silverthorne that are still continuing to be built and bringing that price delta up.
Yeah, you can see the number of properties sold on the condos really dropped in 2025. Summit County, this is our days on market, average discount, months of inventory. These are 3 metrics that we look at for the strength of the market. So average days on market, this is a really volatile number because it really depends on the amount of inventory that comes in. And we get a lot of inventory in May and June. And so that brings the inventory way up. Then that inventory gets absorbed over the summer. And these numbers are looking at a data point across the year. So note that this is very seasonal. What this will show you is that over time, our months of inventory or average days on market, we're probably at 75 right now. So 2.5 months. Some properties are on the market much longer than that. Others are on the market for a few days. So average 75 days when we have all the new inventory come on and everything's going to have a 0 days on market, that's going to drop. As that inventory sits, that number goes back up. Average discount, why I think this is important is we have a lot of people who come in and they're just looking for a deal. They want 10% off, 15% off, 20% off, because they're reading the headline saying real estate's crashing and we can get a deal. Well, when you look at this average discount, this is across all of our properties, condos, single family, everything, all of Summit County. You'll see that it's 3% off. 3% off list price is where we're averaging. COVID, people were paying over list price. So about 1% over. So there's no real bargain basement purchases here. Months of inventory, you'll see we go back from 2010 on that. So back in 2010, this is the recession, right? Remember 2008 recession, 9, 10, we bottomed out in 13, but we had 30 months of inventory. And I remember those days. We had 2,000 properties on the market and nothing was selling. Right now, we're at about 5-ish months of inventory. Again, that shifts very seasonally. This summer, we'll see 8 or 9 months of inventory when we get all of the inventory that's in. But overall, this trend is still saying it's a seller's market. We feel like it's a buyer's market in some sectors and a seller's market in other sectors. It's very property specific. STR regulations.
All right.
All right. Okay. So when you're buying property in the mountains and you want, whether or not you want a short-term rental, it's very important to understand this because the ability to obtain a short-term rental license affects the value of your home. So Candice is going to kind of run this conversation because her and Jennifer, our assistant, created this STR guide. We've included it in here, but we will probably be moving through it relatively quickly. So Candice, I'm going to let you get started on what is the STR landscape in Summit County? What do we have?
So we have people that reach out and ask, can I get a short-term rental? And we say, well, maybe. It depends. And it depends on a lot of factors. So we're going to try and walk you through the different levels. The first thing is just where are you looking? You can see on this chart that the pink areas are towns. Everything in between those is unincorporated Summit County, and we'll dive a little deeper in that.
These are the different jurisdictions that govern the regulations. So we have 7 or 8 right now. I don't know, 7 or 8.
Montezuma.
Yeah. Okay.
All right. So if you're in unincorporated Summit County, so outside of those pink areas, outside of these pink areas, you're in 4 different basins. And within those basins, it's not just whether you're in Summit County or in the basin, there's also resort zones within those basins. So for example, Copper is within unincorporated Summit County, but it's in a resort zone, so you can get a license in some areas. But in the
same zone though, same basin in Frisco, can't get a license for probably like 20 years. Yeah. Okay, I'm working on the slides. Here we go. Yeah. All right.
All right. So in the resort zones, which there's a little baby resort zone in Breck, there's a resort zone in Copper, and then Keystone has incorporated, so that's separate now. You can get licenses. There's caps within each of these 4 basins. 3 of the 4 basins are on a waiting list. The 10-mile basin is not close enough yet to even open a waiting list. So you can see how many people are on the waiting list. We're saying that we're just seeing pretty slow turnover. So it's a little unpredictable, but we think years, particularly in upper blue and lower blue. When you do get to the top of the wait list, you can get a type 2 license. If you have a house and you can rent a portion of your house, there's a lot of nuances to what that means. They do allow type 1 licenses where you rent to local workforce. So it's complicated.
We're going high level here.
Yeah.
If we need to dig in, we will. Here it is. Okay.
Yeah.
Next.
All right.
Breckenridge.
Go ahead.
In the town of Breckenridge, so we're in the pink line of what is incorporated in Breckenridge, which is everything that's in a line here. There's 4 zones: resort, zone 1, zone 2, zone 3. Resort and zone 1, we still have licenses available. Zone 2 and zone 3, there are not licenses available. In zone 3, people are actually leaving their wait list position to their heirs because they're probably not going to see it in their lifetime. So this really affected values in those areas when the Breckenridge Town Council made these rules. So
yeah, especially because some of them are like one neighborhood over,
yeah,
you can or can't get a license. And it really affects the property values. Like Amy was saying, sometimes people think, oh, this is a great deal, but if you can't rent it, that really affects the numbers.
Yeah. I already moved on to Dillon.
All right, let's go to Dillon.
We're in Dillon.
So Dillon, very similar. A common theme here is you think you're in Dillon, but you're actually in unincorporated Summit County. So that red area, which is off Straight Creek Drive, over by Dillon Valley Elementary, is all unincorporated Summit County. So you cannot get a license. You can get on a wait list. But in the pink areas over by the marina and on the lake, you can get licenses because those are in town of Dillon. And at this time, there's no restrictions.
Frisco.
I'll talk about Frisco.
You talk about Frisco.
So the Frisco STR guidelines say that it's 25% of the housing stock, about 900 units. That fluctuates as they add workforce housing and other units. We're seeing it take 6 to 9 to 12 months, depending on the seasonality. But again, common theme, there's 2 little holes in there.
Circle them here.
Yep.
And here.
Which are right across the street from others.
And Bill's Ranch.
Yeah.
Right here. Yeah. So if you're here, if you're this house, no license. Or if you're this house, you're in Summit County unincorporated. That's the 10-mile basin wait, 20 some years. But if you're on this side of the street, where'd my cursor go? If you're on this side of the street right here, you're on the Frisco wait list.
Yes. So at least Frisco is a little bit more predictable because you can see how long people have been on the wait list and you can understand that there is hope of getting a license within about a year.
I want to make one other note here. You only need a license if you're renting less than 30 days. If you're going to rent 30 days or more, none of this applies. You don't need a license. You can just rent your property.
Good clarification.
Yep.
Keystone was recently incorporated, so they're setting up their own government. At this time, they're saying we're allowing STRs. We'll look at it later once we figured out how to run a town.
I also don't think they're going to restrict it. It's very much it was built as a resort. Note in Keystone Ranch, this is Keystone Ranch here, single family homes. Where's this? Anyway, in Keystone Ranch, the HOAs. There's different HOAs there. Many of those HOAs restrict the rentals. This is Keystone Ranch back here. Sorry. Ranch, Summit Cove.
Yeah.
Summit Cove, by the way, Summit County, unincorporated. You're on a wait list.
All right. So
are you confused yet?
Yeah. So now we're in the next jurisdiction, pointing out where it's unincorporated and where it's a town. Silverthorne is generally friendly to short-term rentals. They do have caps, but right now everything is below the cap. So you can get a license in Area 1 and Area 2. Area 3 is purpose-built workforce housing, there's no STRs allowed. As you can see, town of Silverthorne does not cover Wilderness.
Wilderness is down here.
So that is unincorporated Summit County.
Blue River, another somewhat confusing. People think everything south of Breck is Blue River, and we call it Blue River, but there's actually town limits in Blue River. Within the town limits of Blue River, which is pink here, you can obtain a short-term rental license because the town does allow it. Everything that is south of this pink zone, which includes Alpine, Breck Sub, North Star, Quandary Village, that is unincorporated Summit County, and you are on a wait list.
With people in Breckenridge.
With people in Breckenridge and Peak 7.
Yes.
Yes. Okay. Did we?
One final
Are we
thing in
clear as
Blue
mud?
River.
Oh yeah, go ahead.
We thought we were done with legislation about short-term rentals, but Blue River just added a new one that says you're only allowed one short-term rental per person because they had some investors that owned too many.
Okay. On the short-term rental, we have a guide. It's on our website. So you can find that under our invest page, and there's a short-term rental guide. It's also on our blog. We wrote a whole blog about this, so you can download that.
You can also call us. If
You can.
somebody's like, can I short-term rent this? You can say, I'm going to call Amy and Candice because this is too hard.
You can probably give us the address and we might know.
Yeah.
We might just know
Sometimes
off the
it's
top
in
of
our
our
head.
heads. Sometimes it's in our head. And that's scary. Okay. So the next topic we want to talk about is unique mountain due diligence. So what do we do? What do we need to look at? What are the special considerations of purchasing a home in the mountains as a second home or a vacation home that you would not think about when you're purchasing homes in primary markets? We'll just compare it to Denver because that's what we know. Here's the list of things we're going to talk about today. And a moose. Is this from your house?
It is.
This is Candice took this from her house. Pet moose. We're going to talk about homeowners associations, insurance, the alpine environment, well and septic, and use patterns. First, homeowners associations. Go for it.
All right. Well, we have a little quiz. So I'm going to start with what percentage of properties in Summit County do you think that were sold in 2025 had HOAs? Give you a second. It was 83%. So this isn't like one of those things that a few people have to pay attention to. Most people have to pay attention to them. There's a few things that we try to work with our clients to understand. One is the financial health of the HOAs. What we've seen in the last few years is insurance has risen dramatically, and we're also seeing some deferred maintenance and just the age of our homes are reaching about 50 years. So we have a lot of capital improvements that are coming due. And so just understanding how well the HOA has planned for them and how well they're positioned to take care of maintenance and to absorb these rising insurance costs and how they are choosing to address them. So whether they're doing special assessments or building it into dues or they have the reserves built up. So we work with our clients to kind of review all these financials, and Amy's going to give an example here shortly of one that we just experienced.
I have a number of examples.
Yeah,
I'm not sure which one I'm going to give, but
and then we look at the rules. So some don't allow pets, for example, particularly in the Keystone base area, and some only allow parking for one vehicle or two vehicles. So there's some specific rules that are hidden within declarations or bylaws that sometimes you have to dig up and pay attention to. We've talked a lot about special assessments. There's different ways HOAs are handling a lot of this maintenance. But special assessments are real. I'm going to let Amy talk about a couple of her experiences with those. And then rental caps. So certain HOAs, some only allow, for example, 50% of the units to have a short-term rental license. We've seen that in town of Frisco. So even though Frisco allows short-term rental licenses because you've gotten off the wait list, your particular HOA might have additional rules on top of that, or they might not allow them at all. And then insurance renewals, we are seeing, I think in the last 6 months, the HOA documents I'm seeing are our insurance premiums are like renormalizing. They skyrocketed like crazy. And that timing and the cycle of it was really inconvenient when everything was on fire or there was hurricanes. And I think now we're starting to see a little bit of relief, but the insurance has gone up so significantly, and HOAs are really just trying to navigate what that looks like. The last piece that I'm going to touch on is working capital. So sometimes our clients are surprised when they see a bill for 3 months of HOA dues, and they're like, what? I thought the seller was paying for all of this. Well, Amy likes to say this is your gift to the HOA reserves. So it's very common to see 2 or 3 months of working capital due from the buyer at the time of transfer of ownership. So that's something that we like to keep in mind. And then I'll give one example here, and then I'll turn it over to you to give the other examples. But I had a client that was under contract, and then we learned there was some leaking on the decks. That was a surprise. And then we learned, oh, well, it's not just one deck. And so this is a screenshot from their meeting minutes where they were like, let's review the budget, and let's talk about dues increases, and let's talk about the special assessment for this surprise capital improvement we have. Oh, but wait, we don't really know what it means. So let's review the report findings and do some more testing, and then talk about a schedule to address the real big issue units. And then let's talk about fixing the interiors. And then maybe sometime down the road, we'll even talk about like what this means for other units that haven't had leaks yet. So this is an example of, this was in meeting minutes that if you don't read them, it could just be a surprise. And it's big dollars here. So
yeah. I think on the special assessments, we're currently under contract on a property, and the listing agent said, hey, there's a special assessment coming up. It's for $1,660. I'm going to give the numbers.
Yes.
It's for $1,660 a unit, and it's to replace the roof. And we're like, okay, great. Well, we read into the minutes, and it's to replace one roof of 5, or the total of 5.
Yeah.
So our client, we went back with our client. We said, well, we just happen to be buying this when you're just starting the roof improvements. There's going to be at least 6,000 more of assessments just to our unit if it's $1,660 a roof. So we're negotiating that as part of the contract. But that's something we didn't know about until we actually got into the due diligence. So we are under contract, we are in due diligence, and we are discovering these things. Have another deal down the road where the buyer, we represent the seller, the buyer had to switch lenders. And the buyer had to switch a lender because of the insurance deductible for water leaks only, which was a certain amount of unit, which threw it over this tolerance that is a rule for Freddie and Fannie financing. So the buyer had to switch to a portfolio lender. So we are seeing that sometimes in order to afford insurance, the homeowners associations are putting more of the risk of the deductible on the owners, but that actually can run you up against a Freddie Fannie rule, which we just learned. And you know what about that? Sometimes the Freddie Fannie rule is enforced and other times they don't even look at it. So you don't know.
Right.
Until you get all the way into underwriting. So that was an interesting situation. But homeowners associations, they are very prevalent, and they are probably the thing that's most going to affect your day-to-day life.
Yes.
Yep. All right. We're going to move on. Insurance. We're going to go back to insurance again. We love insurance. Insurance has become an issue in the mountains as it's gotten more expensive, and I'm going to have Candice talk about roofs in a minute, but things that we look at and what we try to do when we have a new buyer is we try to have them go to their insurance agent and see if they can get coverage on the property. We also ask the seller, who's your agent? Who's your coverage with? And this is something we like to do early. Availability is becoming more restricted in the state of Colorado as some companies pull out. We do have wildfire risk. Deductibles are shifting, as I mentioned before. People are getting higher deductibles in order to bring down their insurance costs. Replacement cost is something that one must look at carefully as building costs go up. You want to make sure that your insurance covers what it would cost to actually replace the building, and check on that annually. And then HOA insurance versus owner insurance, since 83% of our sales last year had homeowners associations. The master policy of the HOA will tell you what sort of insurance they have, and then your insurance agent can find the guidance in the declaration to understand what sort of insurance you should have. And that is sometimes going to differ based upon the homeowners association. One thing I wanted to add here, I don't know, did we add it in here? The loss assessment coverage. Loss assessment coverage is a great rider that you can get on your insurance policy when you own in a homeowners association. That your agent may not tell you about this, and it might not be obvious, but the loss assessment coverage will cover special assessments for unanticipated events. And I had a situation where my clients had this coverage and there was an accidental leak that took out 3 giant boilers. The special assessment for their unit was $15,000 just for their unit, and their loss assessment coverage paid for it. So look into that if you're in a homeowners association. And Candice, you want to talk about roofs? You're like the roof expert.
I don't know if it's a good thing or a bad thing.
I don't
to be
know.
the roof expert. But we've had three, and then one other that we were bidding on where insurance would not insure the property with the current roof age. So we're kind of getting to that, like if things were built in the 80s or in 2000, they have reached their maximum life, and insurance just doesn't want to take on this liability of paying for $20,000 to $40,000 roof later on. So we've had one that was a large single family home in Blue River that needed a new metal roof. We were able to negotiate it during the contract, but then we learned, oh, we need it done before you close. So we had to get our roofers out there sometimes in April when it's still snowing and just try to find that magic window in a week to get a new roof. And then we had another one where we also needed a new roof, but it was an unknown at the time. The insurance said, yeah, no problem. And then right before we were about to close, insurance was like, actually, no, we're not going to insure that. So like Amy said, talking to the insurance company early helps us be able to negotiate that during the transaction.
Yeah. And I mean, and what we're always negotiating there is the cost of it. Who's paying for it? Where's the money coming from, right? So if the seller doesn't have the upfront cash to pay for it, maybe we're using some of the earnest money to do the roof. Maybe that buyer, we had a cash buyer that this happened to, and they didn't have to have insurance to close. They still got the insurance, but they had to get a roof shortly thereafter. If there's a lender, the lender is not going to play any games on this, and they're going to want a new roof. So it is a huge deal that we're dealing with. And we've got more listings in the hopper that are coming this year, and we're going to be in the same exact boat, roofs.
Yeah, and we talk with buyers and sellers about it.
Candice has a good roofer. we give this guy a lot of business.
Good to get to know the roofers, because sometimes you need them in a pinch.
Yeah, make friends with a roofer, everyone. Alpine environment. I'll let you grab this one, Candice.
Okay.
Yeah.
I'll start with this one. So this is the civil engineer in me that comes out when I look at something like this picture, which was an actual property that we looked at by ourselves and with our clients not that long ago. And this is truly what it looked like. There was a 4-foot dangling icicle that was swaying back and forth in the wind. And there was this ice skating rink right outside the deck. So some things that we have to think about that sometimes our builders don't really think about are like snow loads on the roofs, ice dams, just really thinking about the shade pattern. I had a client that was like, I found a shade map that will show you where the sun is and where the shade is at any time. Because it really does matter. It matters how much you're going to be shoveling. It matters where you need heat tape. It matters where things are going to melt and what those drainage patterns look like. And sometimes people have thought about it and the drainage is great. And when they don't think about it, it's really hard to deal with later.
You said the words heat tape. Do you know most people don't know what heat tape is?
Oh, really?
Yeah.
Oh,
heat tape.
Heat tape, as I learned, is an expensive thing that you put on your roof, usually in the north-facing areas. So it melts the bottom of the roof and puts that drainage into a gutter that then takes it away from the house so that you don't get ice dams built up on the roof that then freeze and fall on people's heads.
And it goes in your gutters too sometimes to keep the water running. It will increase your electric costs depending upon the amount of heat tape you have, hundreds of dollars a month. So a lot of people, like to know that before. I have had numerous clients, more than 10, when I ask them and I say, okay, did you turn on your heat tape? And they go, what's heat tape? You turn on your heat tape in your breaker box, and it's one of the fuses that you turn off and on. If you don't turn it on, you will probably face ice dams. So it is a lesson that we like to teach our clients, heat tape.
Yeah. And it's something I learned that not every house just has gutters at the bottom of the roof, because it really depends how it melts and how it freezes and where things are going. So it's not, gutters are not just a given. They're usually associated with heat tape.
Yeah.
So yeah. And then freeze damage. We've been in houses that are 40 degrees, and we like to make sure that the water still runs. There's a lot of ways to mitigate all of this. And just a big thing is making sure that you have somebody paying attention, even if you're not at your second home. We have great property home watch folks or property managers that can help make sure that all of this is addressed. But really the best mitigation is to build it in up front. Altitude is another thing in the alpine environment. We have some clients that go to Blue River and are like, I want this beautiful single family home in the woods. And then they're like, I can't breathe because it's 10,000 feet. I still get winded walking up the stairs in our office, despite having lived in Colorado most of my life. But the altitude is real. And then the last one is wildlife. You saw the picture of the moose. He was just back in my house yesterday drinking out of the little roadway runoff pond in front. I have tried to grow a vegetable garden. One, we have a very short growing season.
Very short.
And two, if you actually get something, the wildlife love it. So it's just a part of our life, whether it's your pets you're thinking about or taking pictures. The wildlife are just part of our neighbors.
Yeah. And they remember every year.
Yes.
They come back. One quick thing I like to tell everybody about our alpine environment that some people don't understand, because people have asked me this question, and maybe not this year, but when it snows, starting in, let's call it Halloween, the snow does not melt the entire winter season until about May. So snow removal, moving snow, replacing areas with snow is a huge expense and a huge business up here. So that is in large part expenses that your HOA will cover if you have an HOA, or you're going to have to get a snowplow person for your driveway. But just know that moving snow around is a huge business up here.
That's a good point. And where to store it is
where to put
equally as challenging.
Okay, alpine environment, there's probably way more questions that people will have, but that's what we have for today. Next, wells and septic.
You should take.
I'll take wells and septic. All right, so many of our properties here are not on city services, so you need a well, which means you need to dig a well. You don't. You should hire a company who actually does wells. Don't dig your own well. And a septic system. So things that we look for when there are existing wells, we can pull those online and we can have all the information about how the well was built, how deep it is, who did it, who it belongs to, and whether it's a household well, which means you can use the water inside, or whether you have augmented rights. If you're on a well, you need augmented rights to fill your hot tub, to water your plants outside, and to water your livestock if you have that. So with the wells, I think the thing that when you're buying a house that has a well, you really kind of want to check on the well pump. That's the thing that's going to go out. You want to make sure it has power to it and that it's functioning, and ask the sellers, when was the well pump last replaced? You also want to find out, obviously, if the flow's been good. You can do a flow test with an inspector, and you can also do a water quality test. They take the water and send it off. Many homes with wells have filtration systems and water softeners. So that's a whole system that you would manage if you had a house with a well. Anything else about wells?
You want to talk about the augmentation?
Yeah, you need it if you have a hot tub. Yeah. I mean, I touched on it, but yeah. Septic systems. So septic systems, you're not connected to a sewer line. You need to have a septic system. When properties sell in Summit County, an OWTS permit is required, and that's where the seller orders that. The seller has a company come to their house, and these companies specialize in not only pumping the on-site wastewater treatment systems, but they also inspect them. Doesn't that sound like a fun job? Anyway, they inspect them to make sure they're working. And when it comes time to transfer the property, then you get this permit from that company that is licensed to provide I guess it's more like, yes, it is working. Yes, you can transfer ownership. Candice is going to talk about the caveats on that. But oh, I forgot. Yeah, you go ahead.
Yeah. So we've had a couple with septic systems, and usually the inspection permit comes back as like approved. There's some things checked and the seller's like, here you go, you're good to go. But at the bottom, there's some recommendations from the inspector. Sometimes it's like, oh, this pump needs to be checked in 2 years, or this latch isn't quite working. And usually they're not major because they wouldn't approve them, but they're minor maintenance items that could turn into bigger things, or they're notices of, in 5 years, you should have this pumped again, or things like that. And sometimes the sellers are just like, not my problem, here you go. And there isn't really something in the contract associated with objections associated with this permit unless you write it in. It's really just, they need to give this to you, and at due diligence, it's fine. And then, but we usually don't get these until right before closing because the seller waits until they're under contract.
Well, it takes a long time. It takes a long time to get these people out here too. And it's winter.
Yeah.
And sometimes they have to dig. So to actually access these, sometimes you have to wait to close to get this OWS, or you pay them thousands of dollars to dig out the snow. Ask me how I know. Because you could have 10 feet of snow on top of the septic lids.
Yeah.
Yeah.
And a lot of times when we're under contract, like between October and May, like you were saying, we don't know where the septic is because we can't see it unless they have documentation of it.
Yeah. So I guess what we'll say about that. One other thing I want to say about septic systems is when they are built, they are rated for the size of the home, which is rated by the number of bedrooms. So we had a listing last year that was a big giant house with a septic that was a 3-bedroom septic. So what does that mean? Well, I mean, can you live with it? Sure. Are you gonna have to pump it more often? Sure. Does any buyer want to come into a property where they've got 5 or 6 bedrooms in a house and it's only rated for a 3-bedroom? No, they want that fixed. And the cost to expand that septic was about $50,000. Yeah.
Not cheap.
No, it's not cheap. And it requires excavation, and it requires it to be good weather. So septic systems, just note, if you're doing a deal and you got a septic system, it's hard to get them done in the winter. Yeah. You just face more liability and risk because there's things you just don't know. Same goes with roofs when roofs are covered in the winter. That was out of order, but all right.
Yeah.
Go ahead with resort fees and transfer taxes.
So we'll start with resort fees, and this is different than HOA fees. There's extra dues that usually are associated with amenities. We see them in Copper and Keystone. And they're sometimes listed as quarterly, sometimes as monthly. So you have to pay attention to what the actual duration is. But an important thing is if you have clients looking on Zillow or other IDX feeds, this isn't a normal feed that comes in. So it's an added cost, and it's a recurring cost that people sometimes miss when they're looking at properties. And then we have transfer tax in Summit County. So, and it's different, not quite as bad as our short-term rental regulations, but slightly different in each of our areas. So we have 1% transfer tax in Frisco on all properties. Some of Silverthorne has 1%, some of it doesn't, depending on when things were built. Copper has 1.5%. Keystone, it's between 1 and 2. Breck, it's between 1 and 2. But unincorporated Summit County, they're strict on short-term rentals, but they don't charge a transfer tax. And really, a lot of these fees go towards workforce housing. Towns, municipalities are building up their workforce housing budget with these transfer tax. Typically, these are paid by the buyer at closing. It's all negotiable. It's all part of the purchase price. So in 2022, I didn't hear of any sellers paying for transfer tax, but now we're seeing a little bit more people splitting and other things. Do you want to talk about the secret developer?
I'm going to talk about the secret developer impact fee. The secret developer impact fee is something that is kicking the can down the road. And let me tell you what this is. In Summit County, if you build a house in Summit County unincorporated, they want you to pay an impact fee for having a new property and how it impacts the community, essentially affordable housing. This is going towards, affordable or attainable housing. However, they have developed an exception or a way that the developer can actually avoid paying the impact fee, which I believe is a 1% impact fee. No developer is going to pay the 1% impact fee when they have this option. Instead, they put a covenant on the property that is a 0.3, so not a third of a percent. I think it may be 0.33 or it could be 0.25. I think it's 0.33 though. It's 1/3 of 1% of the value of the sale price at every sale. And the buyer pays that. So for perpetuity, and I always say perpetuity is as long as the dinosaurs come back. That's how long it is, how long it lasts. In perpetuity, every time that property sells, the new buyer or somebody is covering this impact fee. You know what? Nobody knows about this. The original developer might know. If you're buying it from the original developer, they and their broker might say, oh, there's an impact fee. But you usually find this out when you get the title commitment back. And you're like, oh, hello. We're paying, there's an extra fee that we're paying for that we didn't even know about. Nobody disclosed. So if you have a good local broker and you know that you're buying a newer home, because this is a newer rule, a newer home in Summit County unincorporated, you might be able to contract for this in the beginning to put in who pays what fees. And I would probably check other and say if there's an impact fee that's being paid, it should be paid by this party. So anyway. Yeah. That was a lot of talking about a secret fee, but it's true. Next. So I usually tell our clients when I say, have you ever had a second home before? Have you ever had a vacation home before? And if they haven't, I say, you have purchased primary homes before and you know what you need in a primary home. You know how many bedrooms you need, you know the size of the garage you need. Do you have a dog that needs a fenced backyard? When you're buying a second home, you haven't quite thought through exactly what you need and how you're going to use it. These are the questions that we ask our clients as we go through to help them narrow down the best property for them. What I will say, the usual thing that restricts the search is the budget. If you have an unlimited budget, and an unlimited budget here is like 20 million, maybe 10 million. I know it's ridiculous, right? With an unlimited budget, you can pretty much name your list and we can probably find it for you if it exists. If you don't have an unlimited budget, and most people don't, and don't wait for an unlimited budget to come buy a place here. But these are the things that we ask people to think about, and it helps guide us into finding them the right property. Do you want a short-term rent, long-term rent, or not at all? And as you know, short-term rentals are a lot of our conversation and a lot of what we talk about. Are you going to manage the property yourself if you're renting, or are you going to get a property manager? Are you winter or summer people? Are you entertaining friends, or is it just your family? Ski access is a huge question. Do you want to be ski in, ski out? Can you drive to the slopes? What about a bus line? There are, something to note is within Breckenridge and within Keystone, they have their own resort bus system in addition to our county bus system. So it's important to note that if that's something you are interested in. What amenities are important? Man, some people don't want to pay for a pool.
Yeah.
Other people want a pool.
Some people want a hot tub.
Some people don't. Some people want covered parking. Other people don't care. We really like to understand your amenities and pets. We've talked about pets so far. One interesting thing about pets is we do have some complexes in River Run Village that don't allow pets, but most homeowners associations restrict pets to owners only. So if you do decide that you want to have renters and you're going to rent your property for a year, everybody up here, wants a rental that's pet friendly, but your HOA is probably not going to allow it. Anything else on? Yeah.
With pets, I've had more clients recently that are like, I don't want to be on the third floor because I don't want to walk my dog up and down 3 flights every time they have to go to the bathroom. Or I don't want to be on the second floor because I don't want to schlep groceries up and down stairs. So those are things that are kind of adjacent to pets, but like, as we think about our condo buildings, just access and what's important to you.
Yeah, some have elevators, takes it away.
Right.
Others don't. You're climbing a lot of stairs. There's one complex where I had a listing and it was on the 3rd floor and had 57 stairs. And people would just say, well, are there stairs? And I go, well, 57. I can't read them every time. So that's great for some people and others.
Yeah, if you want to work out, my husband would love that. I'm like,
yeah.
No, I don't like to carry groceries upstairs.
That's why you have kids. That's what I say. That's why I have my children. They're going to carry the heavy cases of soda. All right, next, investor considerations. Leading into this, we have many people who come to us and they have seen Instagram posts and they have rented Airbnbs before, and they understand that our properties here have great rental potential. And they do, because we are a resort market and people come here to vacation. Just to give you a sense of the numbers, we have 30 to 35,000 full-time residents and over 4 million ski visitors a year. It is why our community has all of the fantastic amenities that we have and why it's a great place to live. But we're going to talk you through the things that we talk about when we talk with investors or people who want to make money off of their rental. First of all, we have gone through the short-term rental conversation. So this section of the class assumes that you have a short-term rental license. So people say to us, well, can I make money? You know, can I buy a property and can I make money? And our answer is, it depends. Here is how it depends. This is what we call the quadrant. And there are a lot of different variables when you're looking at the costs in owning a mountain property, but the 2 variables that have the biggest levers in terms of what it's going to cost are, do you have a loan or not? And number 2, are you going to manage the rentals on your own or hire a property manager? So with those 2 variables, that gives us 4 different circumstances where we can analyze one property to say, can you make money or not? So in this quadrant, in the upper left, you have purchased it with cash and you don't have a property manager. And we can go through all the numbers. This is an actual property that we sold, gosh, probably a couple years ago. But the numbers are still relatively close. If we're off, it's just going to be a few $100s here or there. If you purchase the property with cash and you don't have a property manager, you are making $3,400 a month. And we tell people a cash purchase and you short-term rent it as much as you can, 1 to 3%. That's what you're going to make, 1 to 3%. The other side of the equation, bottom right, is you purchased with a loan and you want to use a property manager. Now, this is what most people want to do. They want to leverage the property. They don't want to bring 100% cash. They don't want to bring $1.25 million to the table. They want to finance 80% of that. And they don't want to manage the short-term rentals. Do you want to be picking up your Airbnb questions all the time? No. In that case, with a $1.25 million property, you're subsidizing the property about $4,000 a month. I wrote an article on this on my blog. You're going to have to dig back for the blog a little bit, but we did an analysis on this and said, if you were to purchase a property at 600, 900, or 1.2, where do the numbers shake out? So you can see how much you would subsidize the property based on those purchase prices. So you can look for that on our blog. But here is an option with a $1.25 million property. Great location, pretty much ski in right on 4 O'Clock Road in Breck. Do you have anything to add to the quadrant, Candice?
Yeah, one thing to add is the rental incomes, and a lot of times we get projections from our property managers. That's usually gross rental income.
Mm-hmm.
So like as you can see in the bottom right, we've taken out the property manager fee. The other piece of that is that's if you're renting at all the peak times. And a lot of times our owners want to use them. So if you have a kid that's in ski school and you want to be using it every weekend during ski season, well, that rental income is going to go down by like 50%, maybe more.
Maybe more. Yeah. People travel on the weekends.
Right. So one of the things we talk with our clients about is when are you planning to use it and how does that affect your overall rental income?
Good. Next. This is a spreadsheet. Candice loves spreadsheets. Overall, what we've done here is really tried to break down the monthly cost of ownership of a mountain property that also includes your mortgage interest deduction. Now we're not accountants. Nope. Make sure you even have mortgage interest deduction allowed. Maybe you've already maxed that out. And it takes into account appreciation. And I believe it also takes into account depreciating? I don't think this is depreciating now. We don't have depreciation in here. So this is not with depreciation. This is with your mortgage interest deduction, along with annual appreciation of 4%, which we know is low. So just to give you an example, this is a loan purchase. And then the next page is a cash purchase, loan, cash, loan. We'll go back to the loan. I'll just do the first one, for instance. So the Breckenridge 2-bedroom, 2-bath, we have a Beaver Run condo. Those rent awesome. You have a monthly cash flow of negative $2,148. When you take your tax write-off from the mortgage interest deduction, that's $23,000 of additional money that you make. Annual appreciation at $39,400. It looks like you're making $36,784 a year. So this is more of a big picture financial tax planning to say, when we're in the quadrant, we're saying, well, you're losing $3,900 a month. I'll go back to the quadrant. See, like, oh no, my cursor's not working. I'm not going back to the quadrant, but in the quadrant, you were losing $3,900 a month. But here you are not, you're making $3,000 a month. Any other thoughts on this?
Yeah, one thing is we looked at things with a purchase price of $900,000 up to $3.6 million. We even have a $400,000 Keystone studio condo in there. And overall, while the magnitude changes, the percentages of your monthly cash flow is like negative 10 to 20%. So it falls within that range regardless of the size of the property.
And that's right here.
Yeah.
Along here. Yeah. If you pay cash, see, you're making 1 to 3%, as we said, 1 to 3%. Your return on investment obviously is lower because you're not leveraging other people's money. Happy to share these with anybody who is interested. We're going to wrap this up. We're at almost an hour here, but I'll let Candice give her final thoughts on who are our buyers and what is it like to own property in the mountains.
Yeah, we have some folks that come to us and say, I want a short-term rental. My budget is $400,000 and I want a cash flow. And we're like, here's the numbers that we just showed if you have a property manager and you're financing. And they say, who would ever do this? Why would anybody do this? And this is a little summary of why people do it. The lifestyle here is really something. We have a lot of folks that are retired or that have worked their whole life and saved, or that have money and are trying to shift and prioritize lifestyle over financial returns. So there's a lot to do in Summit County. There's a lot of people that visit, like Amy said, whether it's skiing in the winter or biking or hiking or playing on the lake in the summer. There's a lot to do in Summit County. And so we see that there are people that are willing to pay these numbers and pay these prices. And we have a limited supply, but we still are seeing a demand of people that want to purchase here. What else do you want to add?
I don't know. I think you kind of covered it.
Okay.
We have demand from not only the Front Range in Denver, but from really all around the country. When we look at the breakdown of buyers, most of our buyers are from the Front Range. the large majority of them. When I say Front Range, I mean Denver Front Range, so Colorado Springs up to Boulder. But we do have a lot of buyers from Texas. That's probably our next largest demographic, and a lot of buyers from Florida, Illinois, and the Midwest. So we are not a market like a primary market where you have people who need to buy a home. We have people who want to buy a home, and I compare it to fine wine, fur, and sports cars. Do you need it? No. Do you want it? Yes. And so it ends up being a lifestyle decision and oftentimes a family legacy, because if you are working with high net worth individuals who are looking to plan their legacy, putting real estate in their trust and in their portfolio is a way to transfer wealth to their heirs in the future, without large tax consequences. So we see that too. Our next slide asks if there's any questions. So because this is a video recording, you should put your questions in the chat, send us a comment, or reach out to us directly, and we'd be happy to answer the questions. And we'll take any feedback.
Yeah.
This is our first run through.
Yeah. Is this helpful, or are there other things that you want to know?
What did we miss? What are your burning questions? Anyway, we look forward to seeing you next time.
Yeah. Thanks
All
for
right.
joining us.
Thanks for joining.